I really wanted us to cover, and I'm coming over to you, Ravi, is that obviously real estate as an asset class is very liquid. But I know that you've seen some technology being put into play to allow some readjustments within one's portfolio, particularly during the pandemic and lockdown. And perhaps, I think people are going to use that technology going forward. Maybe for the last 5 or 7 minutes that we've got left, Ravi, you may want to share a bit more light on that for our audience.
Yes, of course, Lydia. So maybe I can touch on about 3 or 4 bits of legal technology that I think are important, and the current environment has really shone a torch on them. The first one I think is worth touching on is when fundraising, how equalization rates apply. I think this has been an issue that we're facing currently. We've got clients coming to us and sort of saying, well, we set the equalization interest rate at the same rate as the preferred return, so 7%, 8%, 9%, whatever it is. And we're finding it tough to attract new investors, particularly when we've made, a material amount of investments in the fund portfolio. And that's a real issue, obviously. And it's one where the GP has to be quite careful to navigate any, conflicts issues, because of course, it is true that it's good for everybody to expand the pool size and the diversification, but equally, if you tinker with that, if you put downward pressure on that equalization rate, then you're creating a direct financial disadvantage for your existing investors. So we've had GPs going to their investors and sort of saying, look, we want to adjust that. And so some people are now thinking, well, should we have drafting that allows us as the GP to take that view without necessarily having to go to investors, or at least only having to go to the LP advisory committee rather than to the investor base. And maybe when you go and you have to touch base with them, maybe it's on a kind of negative consent, we're going to do this unless 2/3 of you object kind of thing, rather than a positive consent. So that's an interesting one. And actually, pre-pandemic, we built in an interesting equalization rate where we adjusted it from the hurdle rate to NAV following the first audited accounts of the fund on their portfolio. And that was designed actually to stop people gaming it the other way and sort of saying, well, I'm just going to sit and wait. And, if your portfolio has increased beyond that hurdle rate, then I'm going to come in after that point. So that's equalization. One that I find really interesting from a geeky perspective is convertibility into longer term holding structures, and going out with funds that sort of say, well, we're going to go in, but we may, if the GP determines after X period of time, think, well, let's convert this into a permanent capital vehicle, or certainly a longer term holding structure. Now, clearly, again, investors will say, well, we want some touch point, we want an approval, whether it's 50% or whether it's something else. But it's interesting to see GPs thinking in these terms, sort of going out, and this was even not because of pandemic, but we saw it last year, but there's a greater focus now, and sort of saying, well, converting into that structure is interesting because it can allow us to continue fundraising. If you're in a permanent capital vehicle, you can create different pockets, and also you can hold for longer term. So it sort of maybe de-risks your real estate strategy. So that's another bit of technology that's new. One thing that's less new, but I think is still pointedly important, is getting flexibility to do alternative investment vehicles. So that's when you can flip investors into new holding structures. And I think that's because we're seeing, particularly in Europe, different countries, so for example, France, Spain, require different holding structures. And having the flexibility to do that is something that's very important. And so we're fighting for the GPs to get as much discretion as possible, and really pushing back unless LPs have a very specific need, a legal or regulatory or tax need that we need to focus on and satisfy. Interestingly, there's also a regulatory frisson there, in that there is ongoing debate, particularly around Luxembourg structures, which are fairly prevalent in the European market, as to whether you can deploy an AIV that is not itself an EEA AIF when you have raised capital for an EEA AIF. And I won't get bogged down into that, but sort of our views are you should be able to. The final thing I think that is worth touching on is around the importance of allowing co-investment. And what do I mean by that? I mean, if you've got portfolios where you've run out of capital, or it's no longer appropriate for the fund itself to inject equity into that, you know, let's say you've got a portfolio that's coming up to refi, and you sort of say, well, where is that additional equity coming from? Noting that, you know, banks may be much more conservative at this time. How are you going to manage that? So, couple of points there. One is at the fund level, at the LPA level, you should make sure you've got good flexibility to allow co-investment, and, you know, luckily most funds do have that. Then when you look down at the JV platform level, that's where I think some GPs who have been caught out differently from others, essentially having some kind of flexibility to allow preferred equity or shortfall financing at the level of the JV platform is pretty critical. And we've seen examples where GPs have needed to use this. And the rule of thumb there is you get something along the lines of, well, we'll go to everyone. And if everyone takes up their pro rata share, you're at par across the equity base. But if some of you don't, maybe there'll be a rate somewhere between 10 and 15% applied to those of you who choose to fund, and maybe we can also go to third parties to plug the gap as well. So that's a really critical bit of structuring that I think is worth getting right these days.
Thanks very much, Ravi. I know we're kind of running out of